Can you time the stock markets? Every day, I see posts asking when to buy or sell stocks. Everyone wants to time the markets, but can they? Does market timing ever work? By the end of this video, you will have a confident and thorough understanding of whether market timing works and when the best time is to invest. This video will be 100% based on research. This video is not based on a personal theory or opinion. When you want answers, look to the science and at the numbers. To illustrate, I'm going to give you an example using some numbers taken from the Personal Finance Club. Ben, Angela, and Maggie are friends who began investing together. They began at the same time in 1979 and continued investing in an S&P 500 index fund for 40 years until 2019. They reinvested all their dividends and never sold once they invested. They each saved $200 of their income every month for a total of $96,000 each. However, they were different in the way they timed the markets. Ben and Angela competed for who could time the markets the best, each bragging on YouTube, Facebook, and Reddit about their investing prowess. However, Ben was the world's worst possible market timer. He watched the charts. He saved his $200 every month in a 3% savings account, waiting for that special moment to invest. When he felt it was the right time, he put all of his savings in. Turns out, he put his money into the absolute peak of the market right before the market crashed on Black Monday. Upset, he started saving so he could time the next bottom. Several years later, everyone he knew was investing, so he put it all in. This time, it was at the peak right before the Kuwait War. He kept saving and watching the market shoot up. Afraid of losing any more of the bull market, he went all in again, right at the peak before the dot-com crash. He invested his money again once the market seemed to have stabilized, but it turns out he managed to do this again at the peak right before the financial crisis. Ben, of course, couldn't tell anyone after all the bragging he had done, but he was a terrible investor. Despite his terrible timing, he turned his $96,000 into $663,594 because he reinvested dividends and never sold. Angela, true to her word, actually was the world's best market timer. She saved her $200 per month in the same 3% interest savings account, waiting for the absolute market bottoms, and nailed every single one Ben missed. She perfectly timed the bottom after Black Friday, the Kuwait War, the dot-com crash, and the financial crisis. Tales of her deeds were sung throughout the internet. Her perfection gained her amazing results, and she ended up nearly a millionaire with $956,838. Her perfect success timing beat Ben's perfect failure timing with a 44% gain. Maggie decided she couldn't time the markets. She figured she would never know when to buy in and wouldn't bother trying. Each time she got her $200 from her paycheck, she put it into the S&P regardless of whether it was up or down, how the economy was doing, or what global events were occurring. At the end of the 40 years, Maggie had $1,386,429. Even without perfect timing, she beat Angela's flawless timing by over $400,000. How could Maggie beat someone with perfect timing? Because time in the market beats timing the market. Putting your money to work for you is better than waiting for the right moment. Those periods spent uninvested and waiting, on average, will cost you the gains Maggie achieved. Now, Maggie, Ben, and Angela never sold once they invested. What if you did? What if you figured you could not only time the market with your buys, but also your sales? You repeatedly exited the markets in the hopes of getting back in at the right moment. Look at this chart provided by Morningstar. It shows the growth of $10,000 over a 20-year period between 1996 and 2016. Those who stayed invested the entire time had an 8.19% return and turned their $10,000 into about $44,000. However, if you stayed out of the markets to time the bottom perfectly, and you missed only 5 of the best days over a 20-year period from 1996 to 2016, you would have missed out on about $15,000. Let me say that again. Missing only 5 days in 20 years would have resulted in missed gains of $15,000. If you had missed just the 10 best days across a 20-year time span, your returns would have been less than half. If you had stayed out during a rally, thinking it was all overvalued and would come back down for you and missed 60 days, your returns were significantly negative. You can do the same thing with other time periods and you will get the same results. I won't go too into detail, but Business Insider shows identical results for 1993 to 2013. If you missed just 10 days, you had half the gains. This one from BlackRock shows again the importance of staying invested between 1993 and 2012. Even a few missed good days will have an enormous difference. I often hear people worry they will start investing at the wrong time and will lose money as a result. As an investor, you need to focus on the long term. If you are investing for the long term in a stable investment such as an index fund, you can be very confident you will not lose money. According to research conducted by Charles Schwab Company in 2012, anyone who invested between 1926 and 2011 for a 20-year holding period never had a negative result. All investors had gains. Look at this chart. In that first year, lots of people had losses. In the first 3 years, a significant number had losses. By 5 years, the number of people losing was quite small. By 10 years out, almost no one had losses. By 20 years, everyone had gains, even if they invested that money at the absolute worst time. The longer you remain invested, the better you can expect your returns to be. Take a look at this chart. Let's imagine you perfectly time the markets every single year and bought in at the absolute lowest point for 28 years in a row. Now, is that possible? Absolutely not. But this is your fantasy, right? If you managed to perfectly time the bottom of the market every single year from 1979 to 2007 for 28 years, your returns would have been 11.8% per year. Surprisingly, if you bought in at the absolute highs each year, your returns would have only been about 2% less per year. In fact, if you had simply bought at the beginning of each fourth quarter, your returns would have only been about 1% below perfectly timing 28 consecutive years. In other words, not only is it impossible to perfectly time the markets, but the benefits are relatively small. What do top investors say about timing the markets? Bernard Baruch, an extremely successful investor, once said, "Only liars manage to always be out during bad times and in during good times." Warren Buffett has repeatedly affirmed you can't time the markets, once stating, "The only value of stock forecasters is to make fortune tellers look good." Peter Lynch, one of the most successful investors of all time, illustrated exactly what we have learned in this video when he said, "Far more money has been lost by investors preparing for corrections or trying to anticipate corrections than has been lost in corrections themselves." The head of the Schwab Center for Financial Research stated, "Market timing is impossible to perfect." Jack Bogle, the founder and chief executive of the Vanguard Group and the father of index investing, said, "After nearly 50 years in this business, I do not know of anybody who has done it successfully and consistently. I don't even know of anybody who knows anybody who has done it successfully and consistently." I could go on and on with quotes about market timing from the greatest investors of the modern era, but I think you get the point. I hope based on the data you have seen, you recognize you cannot time the markets. Even missing a few good days will result in a loss of significant gains. It is important we remain invested and invest our available capital to maximize our gains. Do you think market timing works? Why or why not? Leave a comment below. I would love to hear from you. Also, please subscribe to this channel because I will be creating new videos every week. As always, good luck with your investing.